Welcome back to the channel, everyone. Today I want to talk about how this senator is potentially, because ain't nobody trying to get sued, being bribed by Citadel to talk positively about payment for order flow. And I want to give you a bit of an update on Evergrande. So stay tuned and let's make some money. But before I dive into the video, I just want to give a massive shout out to the 4,800 of you that have currently dinged that notification bell, because you guys are always the first to watch a new video as soon as it's released. So guys, be sure to drop a like down below, subscribe to the channel and ding that notification bell if you haven't already so that you don't miss another video just like this one. And now I want to dive straight in with the key information. So, this here is Senator Tim Scott, who is recently speaking positively about payment for order flow. He was questioning SEC Chair Gary Gensler at the Senate Banking Committee as to why Gary thinks payment for order flow needs to go, because actually Tim Scott thinks that payment for order flow is crucial for opportune functioning of the markets. Tim was sat at the Senate Banking Committee defending payment for order flow and saying that it was absolutely necessary and that Gary Gensler has got it all wrong. So let's hear what he had to say.
And then finally, it's having an equity position in the marketplace. And to the extent that we make it more affordable for the average person to invest in this marketplace, they have a chance to literally experience the American dream, to exceed their wildest imaginations financially. If you think back 32 years ago, do you have any idea what the percentage of American households that were investing in the stock market?
Well, we've grown, particularly in the last 10 years.
32 years ago, any idea what it was?
I don't know the specific number, but lower than today, about 10 points lower.
Good answer. So 32% of American households 32 years ago had access to one of the three streams that leads to creating wealth in this nation. And much of the reason why they had such limited access is because the fees to make a trade were so darn high. Imagine today the average stock price is around $119 with the S&P 500. If you invested in a stock in the 70s and 80s, your stock would have to increase to $139 before you made a penny, because you were using that increase to pay the transactional costs. Today, it's zero. So literally, you have a chance to invest in the marketplace because we've gotten rid of those high transactional costs. So as you said, today, the actual number of households that are able to invest in the market, 53% of households are invested in the market. Why? Because the price to get involved in the market plummeted. And so when we hear things like banning payment for order flow, it sends shivers down the spines of people who have waited for this day to come. 15 years ago, it was $15 or $20 to make your trade. Today, it's nothing. It literally, you have access to a market. If you're a rural America living in Saluda, South Carolina, or inner city Chicago for the first time, you have a chance to be in the marketplace. Under the Biden administration, those opportunities could vanish away so quickly. And that is painful as a kid who grew up in poverty, who now has access to the market.
So basically what Tim Scott is saying there is because of payment for order flow, people don't have to pay transaction costs to invest in the market, and that is the only reason why nowadays there's more people investing in the market than there was 30 years ago. Now I think there's two main problems with that. The first reason I think that more people are investing in the market is because it's more accessible, not from a fee standpoint, but from a pure accessibility standpoint. Nowadays, people can open up their smartphone, open up their Fidelity app, and buy stocks right there and then. You don't even need an actual Wi-Fi connection. You can do it over 3G or 4G or 5G internet. Back, say, 40 or 50 years ago, you had to go to your local stockbroker to place an order, or you had to go to a telephone, ring him, discuss with him, pay over the phone, and it was a much more lengthy process. That is the first reason why I think that more people invest nowadays in the market than there were, say, 40 or 50 years ago. Tim also notes that say you were investing $100 in the S&P 500 40 or 50 years ago, you might have to pay a $39 transaction fee to do that, and therefore you need a 39% increase to break even on your trade. But he then also says that 10, 15 years ago, that fee decreased to say $10 or $20. Nowadays, that fee is around $5 per trade if you're not using a payment for order flow broker. But what Tim doesn't state is this is a $5 fee per trade, but no matter the lot size. Yes, if you're investing $100, it will cost you $5, but if you're investing $100,000, it still costs you $5. And therefore, yes, fair enough, if you're investing $10 or $15 in the S&P 500, $5 is a very large transaction cost. It's about 33% of your position. But if you're investing much more of a lump sum, say $20,000 or $50,000, then a $5 transaction fee is absolutely negligible. Not only that, but brokers wouldn't necessarily be forced to go to a $5 transaction fee model. They could go to, say, a subscription model, for example, which is what's used heavily over here in the UK. Instead of paying $5 per transaction, maybe you pay $5 per month or $10 per month for access to the app. Or maybe you pay a heightened rate for additional access. Maybe to trade regular stocks, it's $10 per month, and to trade options, it's $20 per month. And especially a subscription rate model would be very, very negligible in terms of where fees are considered. Similar to how payment for order flow is obviously free, paying $5 per month is basically nothing as well. Now guys, before I dive any further, I wanted to talk to you about something. A lot of people, like you and I, don't have a lot of trust in the stock market at the moment, and have been considering other alternative investments. Maybe you like cryptocurrencies, or maybe you want to invest in old whiskies and wines. But have you ever considered fine art? Now, I guess most people don't have a casual $225 million laying around for this famous painting of Marilyn Monroe, which was actually purchased by our very own Ken Griffin. However, Masterworks.io makes investing in pieces of blue chip art a possibility. Maybe you always wanted to invest in a Monet or a Banksy or a Basquiat, but you never had the cash. Well, with Masterworks.io, you can invest in shares representing each of these multi-million-dollar paintings at a fraction of the cost. The total physical art and collectibles market is currently valued at around $1.7 trillion and is expected to grow by another $1 trillion over the next 5 years. And also contemporary art prices even outperform the S&P 500 returns by 174% over the 25-year period between 1995 and 2020. Fine art also has almost zero correlation to stocks, and art has typically outperformed during periods of high inflation and periods of recession as well. Masterworks.io currently holds over $200 million worth of paintings, and over 200,000 users have already signed up. So what are you waiting for? If you want to invest in some pieces of fine art, then be sure to follow the link down in the description below. But as always, be sure to do your own due diligence, as this is not financial advice. Now, it's interesting that I said earlier in the video that he might have been bribed, potentially because I don't want to get sued. Well, Unusual Whales did some digging and found something very, very interesting. Yesterday, in the Gensler congressional hearing, Senator Tim Scott asked about payment for order flow and stated that the inquiry would jeopardise financial accessibility. Incidentally, he failed to note his numerous payments indirectly from Citadel. Now, if I zoom in here, he's received contributions from Kenneth Griffin directly from Citadel Asset Management to the tune of $3 million and also $1 million as well. Yes, these payments were made in December of 2020, but I think they're still highly relevant. Yes, they're old, but Ken Griffin basically has Tim Scott on his payroll. You're not just going to accept a $4 million donation, do some work for Ken Griffin on one day on the 16th and 17th of December, and then never associate yourself with him again. Tim Scott is basically being paid to be Ken Griffin's spokesperson. Now, I think that is very coincidental that Tim Scott thinks payment for order flow is brilliant for the market and allows massive amounts of financial accessibility, when coincidentally he's been receiving massive amounts of money from Ken Griffin. Now, I also wanted to give you a bit of an update on Evergrande. China's Evergrande group is deeply in the red, to the tune of around $300 billion. It is reiterated that it cannot pay its interest for this or for next week. And also the onshore bonds are now suspended. Now, I wasn't quite sure what that meant, but FX Hedge also had a similar tweet saying that Evergrande says all onshore bonds suspend trading as of September the 16th. That means that those $300 billion worth of loan notes and debt that Evergrande has that's listed on the Chinese stock exchange, well, you now can't trade it at all anymore because it's been suspended. Now, obviously, as you may know, stocks, bonds and loan notes only tend to get suspended when they're about to be delisted or they're about to go bankrupt or implode. And interestingly, Katniss AMC did some digging of her own and said, make no mistake, the ripples of this will trickle throughout the world economy. There is no stopping the fall. Chinese official media says that according to Evergrande Wealth staff, the chairman of Evergrande's wife and his father, and a number of Evergrande executives have all redeemed their investments in advance. His wife had $23 million withdrawn, and his father had $9 million withdrawn. Therefore, it looks like all of the top executives at Evergrande are getting their money out as quick as they physically can because they know that Evergrande is going bankrupt. And it looks like they all managed to get in just in time before the bonds were suspended, and I imagine the stock is just about to be suspended as well. Now, I spoke yesterday about how this is going to massively impact the US markets as well, and how it's going to trickle down to us, because so many US institutions have investments in Evergrande, and so many Chinese investors also have money invested in the US. That means that Chinese institutions and Chinese businessmen are going to have to sell off all of their US assets so they can get cash back into their home country so they can support their Chinese efforts. Meaning that they're going to have to sell off tons and tons of US stocks and other US securities. On top of that, it means that US companies that are invested in Evergrande have also just taken massive losses, and they're going to have to reshuffle their portfolios and sell off lots of assets themselves as well, lots of US assets. Therefore, it looks like there's also going to be a hell of a lot of US asset selling over the next coming few days and the coming few weeks. Considering that Evergrande was very similarly sized to the Lehman Brothers, it could absolutely cause a market crash, and it could absolutely cause a domino effect, impacting many other US banks and other Chinese banks as well. Now, we've also got a tweet from Adam Aaron saying, "Cryptocurrency enthusiasts, you will likely know that AMC Theatres has announced that we will accept Bitcoin for online ticket and concession payments by year-end 2021. I can confirm today that when we do so, we also expect that we similarly will accept Ethereum, Litecoin and Bitcoin Cash." This is brilliant that Adam Aaron and AMC are looking into the future and are planning to accept cryptocurrency payments. People might not necessarily choose to pay with cryptocurrency that often, but it does show that AMC is looking to the future and is ready to move with the times. And speaking of which, now is the time to ask for blockchain dividends for the future. And therefore, AMC needs to invest in the blockchain dividend technology now. A 1 cent dividend is all that's needed to test and implement a new system, very justifiable on the books to stay ahead of market trends. And coincidentally, this would give us the blockchain dividend or the NFT payment that we have always needed for GameStop and AMC to prove just how many legitimate shares and illegitimate shares there are floating around right now. Obviously, for AMC to pay a blockchain dividend, they'll need to know the names and wallet addresses of every single shareholder that holds AMC stock in order to pay that dividend. And then they will have absolute proof that synthetics do exist in the market, and they can go to the regulators with that proof. Now, obviously, AMC does need to be profit generative to pay that dividend, but AMC has been performing very well this year, especially over the last quarter, and could be profitable potentially by the end of this year, if not sometime in next year. Guys, be sure to let me know down in the comments below what you think about Tim Scott being bribed by Citadel. And also, while you're down there, be sure to check out the links down in the description below to Moomoo and Free Trade to get some free shares, to my website to pick yourself up some cool AMC related merch, and also to join the private Discord. And as always, guys, if you enjoyed this video, be sure to check out some of my others. Alternatively, subscribe to the channel and ding that notification bell, because that way you'll be alerted when I upload a new video. Cheers.